Hi, everybody. Welcome to the Capitol Grounds podcast. I'm one of your hosts, Joe Fisher. I've got my other hosts, Nick Miller and Luis Cortez, here with me. We do have a special guest today. I'm going to let him introduce himself, but we want to talk to you a little bit today about taxes and how real estate benefits your tax situation. So, as always, we're with SITG Capital, and we're here to provide some education around how to invest in real estate. Uh, we primarily focus on multifamily, but as you guys know who have listened to us before, we're going to talk about other things as well. So, I'd love to introduce Kip. Kip, can you tell us a little bit about yourself?
Yeah, I'm a tax consultant by trade. I own a firm called Decine Consulting Inc. We have a couple locations. One's in Northeast San Antonio. It's called B&H Tax Service. Our second location is in Windward, Honolulu. It is called Akamai Tax Service, and we prepare taxes for a living. That's all we do. That's what we specialize in. That's my career for a little over 2 decades now. And we do have a lot of clients who are exposed to the real estate market and profession in varying capacities. So certainly, thanks for allowing me to be here, and looking forward to learning from you guys and see how I can apply some of these things to our client base.
Yeah, thanks, Kip.
Yeah,
Appreciate
thank
it.
you,
Yeah, we're
Kip.
excited to learn more from you. I mean, taxes is, the we always like to talk about when I was in the financial services industry, that was the number one detriment to you growing your wealth was taxes and how you handled that. So, a lot of wealthy people out there, they're very focused on taxes because it's such a huge part of what you're paying from your income, which we're going to talk about, and we're going to talk about various ways that, as Kip mentioned, real estate does help potentially reduce that. First, though, let's talk a little bit about what any you got some coffee. You got a mug you want to highlight. Nick, what do you got today, man?
Yeah, I brought back my miniature Yeti Rambler again, but this morning I've got I don't know, it's a pretty common brand. It's called Wide Awake Coffee Company. It's got a big owl on the front. I've got a cup of their breakfast blend, and I'll tell you, it's one of my favorite go-to cups. If I've got a regular morning and I'm not feeling anything particular, it's an easy go-to. It's smooth. It's got some great flavors in there. It's nothing overpowering. It's a great medium roast. So check it out. Check it out.
Yeah.
Anybody else? Uh, Luis, I got to ask you, what energy drink? You drinking C4 this morning?
Actually, no energy drink this morning, just some high quality H2O.
H2O. I like it. I like it. Some of the best energy drink right there, right?
That's right. That's right. Gotta hydrate. It's summer.
Kip, what about yourself? Are you a coffee drinker?
I am a coffee drinker. Drink it every day. I'm in a Bucky's mug today. I don't know where this came from. Probably my wife. The coffee is a Hawaiian type of blend. I think it's called the Peabody. It's got its own
Oh,
kind of certain flavors and things like that. I did get it out in Honolulu, and I don't remember the details offhand, but it is a Hawaiian sort of medium to dark blend.
man.
I
Hey,
like
that
it.
sounds like a special one, actually. Yeah. Yeah. I'm keeping it simple today. Actually, the mug's kind of interesting. It's my wife got this mug when she worked at THV11 in Little Rock, Arkansas. So the mug's an interesting one, but keeping it simple with some Cafe Bustillo. It's an easy blend. I think I've talked about it before. Easy for me to do in the morning, so that's what I got today.
Yeah, awesome. Awesome. Well, let's dig in. Joe, you're typically
Mhm.
on top of the news. You've got your thumb on the local markets there. Anything
Yeah.
impacting us in the local area you want to mention?
Yeah, I mean, there's a lot of things, I think we've talked about some of the foreclosures and distress that we're seeing in the markets, and I'm just hearing more and more about it, getting deals daily. as far as, things that operators are underwater on. So there's a lot of that stuff locally. I would say Houston in particular, but I've been getting calls from Dallas recently too. Austin's a very strong market. So we haven't seen near as much there. One thing that is interesting that was recently announced in Dallas in particular was there's the old Valley View Mall site. They're creating a new, it's going to be at least a $5 billion um, build out, but they're going to call it Dallas Midtown. And it's really to compete with what's happening here in the local market, which is Frisco, Plano. A lot of the suburbs are really outperforming Dallas as far as corporate relocations and things like that. So they're trying to create a space that corporations are going to feel comfortable locating to, that's going to have some development opportunities, that's going to have some office space that can be built uniquely for certain clients, things like that. Downtown Dallas doesn't have a ton of that right now, so I think it's a good play long term for the local community.
Interesting. Dallas Midtown.
Dallas Midtown, 5 billion, so it's a pretty big one.
Yeah, yeah. Wow. Be curious to see how that continues to evolve and change over the years.
Yeah,
What's the projected timeline?
They're saying 10 years. So, I mean, with these things, it's a long build out. It's a large site. They're starting on the first project this year, which is just a mixed use project. I think there's going to be almost 300 apartment units and then, retail on the bottom. So they're saying they're going to see how that goes. I think for the office space, I mean, as you guys know, I've got a good friend that's actually, has about 2 million square feet of office space, really struggling. Office spaces. So I think they're kind of cautious on that. They want somebody to commit before they're going to build office. So there's some variables there as far as the timeline. I think, as far as when they're going to break ground on some of those things.
Fair enough.
Yeah. Something I was thinking about, the state tournament is happening here in Austin this week for the high school UIL, and my alma mater sent and made it in. And I was talking to the head coach. He's a good friend of mine. We grew up playing together. We were on the same. He was 2 years behind me, and we both played at Texas as well. And I was talking to him, and he said that the rates for hotels in Austin were astronomical.
Mm-hmm.
And I mean, I think that really plays into where there's just not enough housing, right? And some people are literally staying in hotels right now because there's not outside of the state tournament. There's really not any kind of major event. It's not like a COTA weekend or anything like that, or an ACL or South by Southwest. So I was kind of looking around to see like, okay, what's going on to cause this? And I can't think of anything else other than there's just a lot of people in town who are either feeling Austin out and maybe, working hybrid. So they're staying in a hotel for now, or, because it's maybe a little bit more feasible than a short-term rental. But obviously the supply and demand, even on hotels, is has a lot of pressure on it right now in Austin.
Wow, that's wild. That's wild.
Yeah, I think Luis, you brought it up a little bit, but the short-term rental market is more difficult in Austin too. They've got a lot of restrictions that they put on it.
Yep.
So yeah, if that were to help alleviate some of that market demand, it's not really at this point. And I think they're trying to pass more and more to do that, but we'll see. Austin's supposed to have a more friendly to business mayor now. I don't remember his name. Luis, do you know his name?
Yeah, it's Kirk Watson. He used to be
okay, Kirk. Yeah. So we'll see what happens there. But yeah, prices are still out of control there.
Yeah, I'm hearing some good things right now about him as well. So he's definitely kind of a middle of the road guy, and he's pretty common sense approach. So, and I think you mentioned the short term rentals. I know personally here in our community, the HOA doesn't allow for it, right?
Yeah.
Like if I was going to be, let's say, take a contract or something to go work in Florida for 3 months, I couldn't even rent my house out while I do that.
Yeah.
Which really goes to say, and I think that from a legislative standpoint, something does need to be done about HOAs, because it went from being something about protecting their residents to now controlling and having way too much power, right? And it gets away from a lot of things, but of course there's a lot of controversy around HOAs in general. I think in the big picture they're a good thing, but obviously anything that exerts too much power can obviously be turned into a negative. So
Yeah, of course,
yeah,
in moderation, right?
as my
Yeah.
mentor said, any strength in excess turns into a weakness. So
I like that.
yeah.
Well said.
So
Well,
yeah, do we want to move on to the tax portion of this?
Yeah, let's do
yeah,
it.
Yeah,
yeah,
well,
Kip would love to hear from you. Yeah, go for
yeah, I
it,
kind of
Luis.
wanted to share a little bit about Kip, since
Yeah.
I invited him on and we're covering this. And of course, all of us have a wealth or financial service background, and Kip, specifically in accounting and more importantly, tax as a tax advisor. And I used to work with Kip. And I would say he and I have a lot of similar values and principles. And I think more importantly, we are very strategic thinkers, right? We really try to find the best way to add value to client relationships and really leveraging what's available to us as U.S. citizens within the tax code to make the most of our finances, right? Whether that's leading people to a better solution when it comes to how to structure even their company, right? Whether it's an S corp, C corp, whether to do LLC. I really enjoyed always visiting with Kip because he and I were very aligned in our way of how do we help clients get more bang for their buck, right? How do we add value? So that's why I wanted to invite him today, and I'm glad he's able to join us. And I'll kind of turn it over to him in the essence of one thing we wanted to talk about. Sorry, I'm off my screen here. Is obviously the tax benefits of the way we're structured, and what we offer is passive real estate income and that escaping FICA, right? So that's a 15.3% bump on tax. So tax equivalency, let's just say on our income fund, right, is we pay out 10. That's net of our expenses of $1.25. You add another 1.53 on top of that, where it's a tax equivalent about a little over right at 13%. So Kip, I mean, if you could, if you could speak to how that works, why that's there, and obviously the benefits to that.
Yeah, sure. I think the first thing to mention, just with the business that you guys are in, a lot of people have interest in real estate. And of course, there's a lot of historical reasons for that, and the building of wealth reasons for that. But we see it all the time. With our clients, whether people just like that space in general, and they're willing to put in the work in that space, or whether they just want to be an investor and have exposure to that market that's above and beyond their traditional 401ks or IRAs. And of course, in this business, we deal with a large breadth of people that are have their tentacles in the various aspects of real estate. And there's of course the active portion, which is its own animal, and then the passive, which is kind of you guys' bread and butter. I'll just kind of give an example of someone that's self-employed. What we see all the time is they make decent income, and we teach them how to expense deductions against that income to try to depress taxable income as much as possible. But inevitably, what happens when people are self-employed is we prepare their tax return, and not only is their income subjected to just general income tax, but at the end of the day, and it kind of comes in the middle of page 2, so to speak, of your tax return, or right at the end, is the dreaded self-employment tax. And that can be a big number, especially people that are doing well, and they're already paying income tax, and then you add that 15.3%. And even people that might be running small businesses and maybe even making a modest type of income, they're shocked or very surprised at the amount of tax that they're subjected to. And so sort of definitely a lot of benefits there, but we see it all the time where it's almost discouraging to some clients who aren't prepared for it, or or who are just new into self-employment. And it's a big tax hit. And most people aren't used to it because most people kind of start working for somebody as we enter the workforce, whether that's in our teens or after college or whatever it is. And our employers are paying half of that self-employment tax themselves. And the portion that we're paying, we don't even see because it's just directly deducted from our checks. So when direct deductions, whether it's state income tax or federal tax or half of the FICA tax, we just see that net check, right? We don't get our gross and then we have to pay back our taxes. We just get it net. Well, then the employer is matching that. And it just doesn't feel as sharp when you're just getting that net check as an employee. But as someone who's self-employed, when you're realizing all of that income and then have to turn around and pay for all that stuff yourself, it can be quite a shock as far as what you can be subjected to. So this type of investing, passive real estate, is just one of the benefits where, just think about almost 15 or 16%, you're not even paying at all. So you're taking a portion of your income or your net worth or your resources, and you're investing in these areas of passive real estate. And as you make money and generate income, it's not subjected to that self-employment tax, and that's just a big benefit. Not only that,
Yeah.
but think of it as capital gains versus ordinary income, which is another aspect of benefit as well.
And Kip, thanks for digging into that. Can you just give a quick breakdown for viewers that may not be aware of what the FICA tax covers?
Yeah, I mean, it's Social Security and Medicare. So when we say FICA, most of that is Social Security that gets paid into the government coffers, and then to a lesser degree Medicare that also gets paid into the government. So and then the government tracks that, and then when we retire we get to draw that out, obviously. But in our world, we just kind of lop that all into one of FICA, and it's 15.3%, full boat, and everybody at least pays 7.65 of that out of their own pocket, even if they're employees. It's being taken from their check. So it's just another part of taxation where people are getting that taken from them now for a benefit in the future.
At 15.3, that's quite a haircut if you're not prepared for it.
It definitely is. And in what makes it so substantial is the fact that it doesn't replace income tax or capital gains tax or something like that. It's on top of. So a lot of people pay that straight up income tax on their overall income or their household income, so to speak. They're already paying an income tax number. And then on top of that, you add the 15.3%. So, even if you're in a tax bracket of between 12 and 22, when you're adding that, I mean, you're quickly getting to 35%. Right away on your income tax, and it's not that hard to get there. You don't have to really make that much money to get over 30% exposure and tax with that sort of income. So what do people do? They look for other avenues to allocate their resources to try to mitigate that taxation. And certainly passive real estate investing is one of those, along with other sort of portfolio income or investment income, so to speak.
Yeah, and I think that's a great segue. In addition to the passive income we do provide for our income fund, our Peregrine Income Fund pays the 10% that Luis mentioned earlier. When possible, and for the appropriate account types, we issue those distributions as a return of capital, which can further improve your or potential tax situation.
Yeah, Joe, I was going to ask, did you want to go over the mechanics of that?
Yeah, we can. And then, if Kip, if you have any color to add on kind of how that benefits people and kind of what you see on that perspective. But yeah, basically what we do is, like Nick mentioned, when it's best for the client, we will distribute those returns as return of capital. So, for our physicians that make a lot of money, this is usually going to save them, a significant amount on their tax bill. So the way that it works, right, is let's say you put 100,000 in, you're going to get 10,000 back to you a year. You're going to receive that, and we're going to designate that as that's actually the capital that you've invested being returned to you. Just from a tax perspective, your principal remains the same, 100,000, but after year one, that'll drop down to 90,000 from a tax perspective. So if you pulled out after the first year, right, you would have a $10,000 capital gains tax as long as it's been more than a year, and that's going to be more advantageous than if you're in the 35% bracket, or even potentially higher than that. So that can potentially save you a lot on your taxes, and that's really why we do it. Now, again, it's not the best thing for everybody, but for most people, it tends to be a better way to go about it.
Yeah, so that qualifies underneath what we know as FIFO, first in, first out. So, Kip, did you want to expand on that?
Yeah, I mean, that's great to hear. I think you guys are making a very tax strategic point there. That's one thing that we do. If we're filing a partnership tax return or an S corporation tax return or something like that, that sort of treatment is very powerful because yes, there's an initial capital dump by that individual or business, but if they can first extract back their actual capital, a lot of cases, and even most cases, for owners of these businesses, there's no tax hit at all to that.
Right.
And so, when we're in the weeds of actually filing some of these tax returns, we're trying to strategically treat a lot of those what are called shareholder distributions in the S corporation world, or withdrawals in the partnership world, to a return of capital. I actually do that myself in my own business. When I'm drawing out money, trying to take a portion of that as a return of capital. So the fact that you guys are implementing that in your business is hugely significant, and certainly something that the listeners should take note on, because it shows you guys are really on top of it. And anytime you can do that, or your accountants that you work with can do that, I'm really stoked to hear that, because it's a very tax strategic type of treatment that is very, very beneficial to your investors.
Yeah. A follow-up to that, Kip, I know you and I have had multiple discussions as far as when is it appropriate to incorporate or LLC, S Corp, and how do you make the decision in something like what we have to offer? And I hate to put you on the spot, but where do you think it makes sense for somebody to invest with us as an entity versus just individually? Is there an actual dollar, capital amount, or is it their income or a combination? Where do you think? I mean, because this will actually help educate us from a standpoint of advising them, what to consider. Of course, we're never going to stop anybody if they want to participate, but we definitely want to try to again add value, and I think that's something for us to consider. When we're talking with our prospective clients.
Yeah, that's a great question. I would say that there's a multitude of factors when determining that. To me, that's a tax question. That's a legal question. That's a financial question. I think everybody's going to be different. I think that if somebody was trying to determine that for themselves, I think that they should have a meeting with someone like myself. I think they should have a meeting with an attorney, specifically even maybe a real estate attorney, and then also meet with you guys and kind of take all our different perspectives from our professions and then make the best decision for themselves. There's pros and cons to everything. If you're just investing as yourself, it's kind of easy, but you might have a little bit more liability exposure there. If you use an entity, obviously there's going to be costs involved, but the benefit you get is typically increased legal protection. I'm not an attorney, so certainly verify that with your own attorneys. But I like to see entities come in when the tax benefits outweigh the costs, because you do have costs. You've got to send the state money. You have to work with someone like myself and get your tax filings in order. Obviously, there's a cost involved to that, and I like to get clients to the point where, okay, if they're gonna bear that cost, we're correspondingly getting some sort of tax benefit that's either equal to that or exceeds that, so that they're kind of net money ahead. Okay.
I like that. I like that a lot.
Yeah, most clients, that's what we're trying for. Of course, you get both ends of the spectrum. Some clients that really don't care about the cost, some clients that think cost is everything. I think both of those extremes, I kind of like to meet that in the middle. But if I'm gonna pay for something, I want to make sure that I'm getting the corresponding benefit where that cost is worth it. Another point would be profitability. I've kind of used this example with clients where, if I'm running a business and I'm losing money, I mean, I want to be a sole proprietor because it's very easy to take losses on my tax return against my other income and things like that. But once I become profitable, then usually I want some sort of entity in place at that point for tax deductions, audit protection, certain other maneuvers to get that profitability down as much as possible.
Good deal. Thanks for answering that.
Yeah, and Kip, you mentioned whenever you look at, I like maneuvers. I think that's a great term. When you're looking at some of these maneuvers, you want to make sure that there's what I'm going to call bang for your buck, right? You want to make sure that the money's worth it, that the end result is worth the cost. Something that we see occasionally and more often with those that are already into real estate are 1031 exchanges. And, I'll put a caveat in there. If you are looking to do a 1031 exchange, we will, depending on the value, if it's over $500,000, we will cover the costs, at least right now, for 2023. We'll cover the costs of that 1031 exchange and pay for those fees for you. But 1031 exchange offers a lot of bang for your buck for a lot of those individuals. Would love to hear your thoughts, Kip, on 1031s, pros and cons, or items that you see that we should be aware of when it comes to 1031s.
Yeah, sure. The biggest point I would make on a 1031 exchange, before I even get into taxation part of that, because we do have this conversation with clients fairly regularly, and it's one thing that out there in the marketplace people don't really realize, is you really have to work with a fiduciary to make that happen, or a company that specializes in 1031 exchanges, does it for a living, has a track record, they know what they're doing. That is hugely important, and that is an absolute must. And the reason I bring that up at first is because, I sit down with a lot of clients where that's what they want to do, and they think it's something that you can just declare on your tax return, or something
Sure.
that you can say, oh, I'm doing this, and the IRS is just going to say, okay, cool. Nothing could be further from the truth. You've got all of these rules and all of these number of days out there that you have to meet, and there is a process, and it's pretty strict. And if people don't follow that and they don't do it correctly, the IRS is known for coming in and reversing those transactions, or challenging those under audits, and they have a decent track record of winning those. So that's the first point I would make, is people absolutely have to work with a professional firm to
the QI is absolute necessary, and that's before you close on the property. I've had some folks professionally that sold their property, wanted to do a 1031. I said, I'm sorry, it doesn't work that way.
right.
You have to have a QI or qualified intermediary before, and they have to pretty much, they act as a escrow agent and a legal flow through, and they're not that expensive. And I'm hoping to actually have a gentleman I met who actually is a qualified intermediary come in. He is an attorney. He's a real estate attorney. But yeah, you're absolutely right, Kip. I think that's something people don't know, or when they do find out about it, it may be too late, and then they lose the benefit of that 1031. And we'll get a little bit more into some of the other benefits of it, but we are a 1031 eligible offering, so I think it's really important not just to understand the tax benefits, but to understand the legal flow or the legal process that has to happen for it to actually stay in place.
And we work with a great tax attorney that specializes in 1031s. And so we've got that whole process set up really well, and we've done it, a good handful of times for clients that have qualified for it. But you're right, Kip. I mean, people think it's, it's a really simple process. It's really not. And so that's why Nick had the caveat there. Yeah, that it's got to be the right situation for us, and we will absolutely take those fees on. If it's the right situation, the right client.
And it can be a hefty tax bill if you get it wrong. It'd be a lot. It'd be very expensive.
Yeah, that is true. And the second point, going into the taxation part, and another area where I see kind of clients just kind of staring back at me when I tell them this, and it's kind of blunt, but it's something they have to realize. I mean, if you're going to decide to do a 1031 exchange, essentially it means you don't care about the cash, right? You're giving that up, you're foregoing that. All of that those proceeds are going to be rolled into the next project, or the next real estate asset. So it's for people that aren't looking to walk with cash at closing, and a lot of people don't realize that either, kind of in when we're discussing these things with clients, because they think, okay, I'm going to close and I'm going to walk with this cash, I'm going to be able to do something with it. Oh, plus I want to do a 1031 exchange so I don't pay any taxes. Well, it doesn't work that way at all.
You can't have your cake and eat it too.
Right. And I know it sounds very simple here, but I'm just bringing it up because of what we see in the real world and what people out there in the marketplace, they need to be taught this thing, and
Yeah.
so, somebody who doesn't care about the cash, they don't need the money, it's a great thing, to be able to stay invested in that, throw my taxation out into the future. It's definitely something that should be considered. But if somebody is relying on it for some sort of current income or whatever, life happens and they need the money,
Yeah.
it's not going to be best for someone in that scenario.
Well said.
Yeah, and one more benefit, right? And you're right, Kip. It's usually folks who have significant wealth, right? And they're just rolling from one thing to another. And a big reason is because they realize at death, their beneficiaries will get a step up in cost basis and then never have to pay a dime. So let's just say I bought a piece of land for 500,000 and sell it for 2 million, roll that 2 million into the next property. That next property is now worth 4 million 20 years from now. I pass away. My original cost basis is 500. There's $3.5 million worth of growth. My kids inherit that, get that step up at 4 million, never have to pay Uncle Sam. So it's a beautiful thing.
Good point.
It's just something people need to understand how it works. And and I'm not sure if this is an attorney question or a question for you, Kip, but can you carve out, right? Let's just say you do have, let's say 100 acres, right? And it's one property. And I think I'm answering my question now that I'm thinking about it in my head is, let's say you say, okay, well, I just sold it for $100 million, $1 million an acre. I'm just trying to keep round numbers. And you're saying, okay, hey, I'm going to 1031 half of that, right? And then take the other half and run with it. I don't know. Is that doable to your knowledge, or is it our Joe, or Nick, jump in? Or do we have it has to be the entire thing because it's one property? So I didn't know if they could maybe replat it and consider it two different pieces of property. I'm pretty sure we can get tactical there and how to maximize that for somebody. But that those type of things do happen, or somehow get even. I know people around town. Well, they'll donate 50% of a purchase, so essentially they get to wash it out and still get to roll. It's kind of like a invisible 1031. They'll sell 50 acres to the nonprofit college or nonprofit hospital and sell the other 50 at full. They'll donate 50, sell the other 50 at full market. But the way the tax works is they gave away an equal amount that they sold, so it washes out as zero. So I'm kind of thinking, is there a way to do that without having to, do the charitable contribution?
I would defer to the 1031 exchange guys
Okay.
to that question. To my knowledge, there's nothing that's stopping that, but that doesn't mean there's not certain things. I'm actually not sure.
Okay, no problem.
Just
that's an idea. Just again, you trying to think strategically. I'm like, because man,
Right.
that would be that'd be huge to where we could get, like I said, very, very tactical in how we help clients maximize what they can keep, as well as rolling forward with gains, so that they don't have to. It's kind of like having your cake and eating it too. You get to benefit from the appreciation and still get to offset and keep rolling for your kids, because I'm kind of thinking that for us, personally here. So
I would agree with Kip. I think you gotta defer to the tax lawyer at this point, and then go through all the channels and see. But he brought up a good point earlier that you would absolutely have to do this well before. This would be a planned out thing. You're not gonna be, hey, I've got this under contract, can we do this? It's not gonna work like that.
Correct.
So yeah.
All right. Well, Nick, do we want to jump into opportunity zones?
Yeah. So we've got an opportunity zone fund, which, if you're not familiar, opportunity zones were created, I believe, in the Jobs Act of 2017, where there are portions of the country designated as opportunity zones. you can make an investment into these areas. And if you hold the investment for, I believe, 10 years, then the government says you don't have to pay any taxes on the results of that. Now, it's set to expire, I believe, in 2027. I know that there was an extension. It was the Opportunity Zone Transparency Extension and Improvement Act that was created last year. It did not get passed, but I believe the intent is still there to extend it and update that. Kip, can you provide any clarity, any insight into opportunity zones? And would love to hear, if you have one, speculation of yours for the future of the opportunity zone.
Yeah, I think you covered it well. As far as the 10-year provision and the opportunity there. I mean, the bottom line is, what is the government trying to do? They're trying to get people to invest in these areas, right?
Right.
As far as the future, I do believe this is just what I think. I have no insight on this, judging from
Personal
the past
opinion.
or right. What I think the government is going to do in 2026 and 2027, I would anticipate that they do extend that. I think currently in our government, there's reasons why that didn't make the final bill or whatever right now. I mean, they have more time, right? The government really doesn't move until they have a deadline, until they're up against the wall on a deadline, and that's not coming until 2026 or 2027. So when that happens, yeah, I think they'll probably push that out another 10 years at that point, because I don't think the motivation that they're trying to get the capital markets to invest in these areas is going away anytime soon in the next 3 or 4 years. So I would expect them to extend it.
There's no political points to win right now.
Yeah, no, I think you bring up a good point, Kip, though, as far as, I actually, of course, we've got properties that we're developing in opportunity zones, right? And I actually think there's still quite a bit of room for development in most of the opportunity zones that we operate in, right? We think, it just takes time. 2017, yeah, it was a while ago, but people didn't fully understand how this worked. There wasn't funds set up immediately. It took some time for people to understand how it works. So I think it's still coming, particularly in the Dallas and Houston markets where we do have opportunity zone projects. I live in what's technically an opportunity zone, and it's cleaned up a lot since it's become an opportunity zone, but it's still not developed out. There's still a lot of vacant properties that can be turned into something. So it's coming. I know the pipelines too, and it's coming. But yeah, I think it needs more time, to be honest with you guys. That's just my opinion. I think it needs more time in most of these opportunity zone areas.
Yeah, I agree. And I think as we, the point of the Opportunity Zone Transparency Extension and Improvement Act, what a wordy act. Anyway, I think it was to provide clarity and insight into how the opportunity zones are supposed to work, some of the minor details. And the more that they can flesh that out, hopefully, maybe we'll see this become, a permanent structure in the tax code, or semi-permanent structure in the tax code for us. But that remains to be seen, I suppose.
How do you feel about that, Kip? Another like
Well,
3,000 pages, 3,000 pages to read through.
Right. Well, I think that's a brilliant point. Not only in this area, but in all areas of the tax code. If they would just make these things permanent instead of having them sunset after 4 years or 5 years or 10 years or whatever, that would just help the economy and help investment in certain markets because there's certainty there. Yeah. And the economy does like certainty. And so, yeah, I mean, that would be the ideal scenario if when 2026 comes and they have to move on this, if they would just make it permanent, problem solved. And then,
Absolutely.
very, very helpful. Nick, I think that's a great point that you make, and certainly something that, we want to kind of vouch for, as we talk these things through with our business contacts.
Mhm.
Yeah.
If you're a legislator, take note.
Well, the problem is it's too simple, and
Yep.
and then it actually makes things easy. And
Yeah.
unfortunately, history has shown the older our country gets, the less simplified and the less easy things get, especially when it comes to government and politics. And that's all I'll say on that. Yeah,
Well,
I tell people we're having a conversation around that topic, and I said, well, that means that there would have to be common sense exercised. And they're like, well, yeah. And I'm like, well, common sense is a superpower these days, so it's like, I don't think there's a whole lot of that going around. So
oh man.
didn't mean to
Kip,
cause crickets, guys. Come on.
Kip, I have to say, I appreciate having you on our show.
Yeah, thank you, Kip.
As I think my colleagues will agree with, when we in our past lives in the world of purely financial advice, finding a tax consultant, a tax advisor, an accountant that is proactive and adds value to their client's tax situation is such a rarity. So I appreciate the opportunity to have you on our show and get to chat with you, because goodness, we need more guys like you out there. We can't, just having somebody who's a passive accountant who is only retroactive. They're just missing massive opportunities for themselves and for their clients. So I'm glad to hear all the great knowledge you've gotten and the ways that you help the people you work with. I mean, Luis vouched for you, and if Luis vouched for you, that's pretty big. You can tell he's skeptical of a lot of people.
That's called being pragmatic.
There you go.
Well, appreciate that, and
go
thanks
ahead,
a lot
Kip,
for having me on, Luis. Thanks for inviting me, and guys, this has been great, and I just appreciate the opportunity to have exposure here, and this was really good.
Good deal. Well, thanks for coming on, Kip, and as
Yeah,
always,
thank you, Kip.
good to see you.
Yeah, gentlemen, any last questions for Kip or comments for the show this morning?
Kip, tell us the name of your firm again.
Yeah, the name is Decine Consulting Inc. And that operates under two different DBAs. One is B&H Tax Service in San Antonio, and the other one is Akamai Tax Service in Honolulu. And we prepare tax returns for clients.
Yeah. Hey, real
Excellent.
quick, Kip, give the story behind the Decine, how that came to be.
Sure. So the mid 2000s, I was out in Hawaii for my 30th birthday because I want to get around or get away, I should say. So I went out there for 2 weeks. I learned about the term decine and what it meant, and it basically means anything and everything. And so I had this vision back then that I would develop this consulting firm that basically was similar to this, where we sat down with people and just had a chat, talked about money, talked about anything and everything in relation to money or taxes or finance or economics or whatever. And that, I would one day own my own business. So that's how I developed the name, and I incorporated that back in my home state of Illinois. And here we are 15 years later, and it's come to pass, where I've been able to acquire a couple tax firms and And so that's just the name of the corporation. And we try to do that. You know, there is a financial coaching aspect of my business. There is a just pure consultation aspect of my business. In fact, I'm having one here shortly where people are just going to come in, they're going to sit down and talk. And it's come to pass actually, but it was that many years ago. So
Thanks for
Wow,
sharing.
that's fantastic.
Yeah, love the vision, Kip. That's great.
It's the American dream, right?
yes, sir.
Oh, excellent. Well, we'll include links below to your website, and yeah, if any of our viewers, listeners have questions, please happy to connect you with Kip. If you've got questions, comments for us, suggestions, things you'd like us to dig into, send us an email, leave a comment. Check out our website, sitgcapital.com. And otherwise, gentlemen, if there's nothing else that you guys have, we'll look to see you all next week.
All
I'm
right.
going to take
Thanks,
those
guys.
crickets. Yeah.
Yeah.
Thanks,
Yeah.
gentlemen.
No. Yeah.
Thanks,
we're good.
everybody.
Everybody's waiting their
All right.
turn.
Take care.
All right. See ya.
All right. Take
See you
care.
guys.
Bye-bye.